So I want to say good morning to each and every one of you again. And last week we were looking at the question of Layne and Hart. We've been looking at it for a while. So we've been looking at Layne and Hart for a while, and we were able to complete the revaluation account. We also were able to do the income statement and appropriation account, and we did both the capital and current accounts for the partners. So we left off on Friday at the statement of financial position. Now there is some theory here, and it's just as I would have suggested with the other group. The theory, you should read your notes and answer these theory questions. It says, give one reason why fixed capital and current accounts are preferred over fluctuating capital accounts. Explain why a partnership would agree to guarantee a minimum share of profit to a partner. Clearly explain why assets are revalued when a partner retires from a partnership. So you can read your notes and you can answer these theory questions. We find that when in the online environment and when we give a test in the online environment and we give theories, students do not answer the theory and they have a difficulty answering the theory, and we don't see why they should have that difficulty, because they are at home and they're not in an environment where they are pressed to remember. So that's the theory. So we're here at the statement of financial position. So that's where we are going to be starting today. I don't know if anyone would have completed it, but that's where we're starting.
Hi, ma'am. I have a question. This is Julia.
Go ahead. Go right ahead.
I did the balance sheet for this question, but I didn't balance, but I just trade. And for Dynaman, I started Dynaman and I realized that in Dynaman, in the is the current account or the capital account, he has a negative. Sorry, the one of the partner that is retiring has a negative figure. Now my question is, if the partner is retiring, will he still have to pay that money, or
You
will they have
said
to balance the account, or just leave it as it is?
you said that they had a negative figure. So
Yes,
then
please.
one
I
of the
don't know if I'm
partners.
right, but if there is a negative figure and the partner is retiring, I will still have to like balance the account.
When you say negative figure, what exactly are you referring to? We're trying to get a sense of what exactly you mean when you say that you get a negative figure. You get a negative figure where?
His debit side was greater than his credit side. I think this
Or
is
you mean
the
in the current account?
yes, ma'am.
Or so the partner that is retiring, you're saying that his debit side is greater than the credit side.
Yes, please.
Which meaning, I remember when the debit side is greater than the credit side, it means the person has withdrawn more than they should. So that means the
Yes,
difference.
please.
So then if the debit side is greater than the credit side, then it would mean, you see here when they had the current account, in this current account here, in this current account for Layne and Hart, Hart's credit side was greater than her debit side. So then the difference between the debit side and the credit side, that amount, this difference here was transferred to the credit of the capital account to show that that is money that was due to Hart. So therefore, the opposite holds true. So if the partner is retiring and the debit side is greater than the credit side, it means that this figure is going to come over here on the credit side of the current account, and then that is transferred to the debit side of their capital account. That's what happens.
Okay, ma'am. Thank you.
Because that means that is money that they would have withdrawn more than they should, and they're not entitled to what they would have already withdrawn. They're not entitled to that part. They've taken it out already. So it reduces how much they're supposed to get on their retirement. Basically, that's what happens then. but we will see as we go through if what you came up with is actually correct when we go through some other stuff, right? So this is the,
Okay, ma'am. Thank you.
you're welcome, Julia, and I'm glad that your mic is working again. So this is the current account for, sorry, the statement of financial position for Layne and Brown. And you see that we don't have Layne, Hart, and Brown because Hart is no longer there. So this is the financial statement of financial position for when just Layne and Brown are there at the end of the financial year. This is the position of the partnership at that point in time. Now, in the question, it has stated that the goodwill account was being maintained on the books of the business. So when the goodwill account is maintained on the books, it has a balance. So therefore, your statement of financial position will have goodwill as a line item. So when the goodwill account is being maintained, it means that the statement of financial position goodwill will be in there as a line item, and it's the first line item, and it's called an intangible asset. So goodwill is an intangible asset, and it's the first line item on the statement of financial position. Okay, goodwill. And that 28,000 comes here. That's the first item that goes into the statement of financial position, your goodwill. And then you have your non-current assets, which are the tangible ones, which we have land. And land had a new value of $108,000. So you put in the new value. There's no depreciation on land. So therefore, 100,000 minus whatever the depreciation is supposed to be, 108,000. 108,000. This is the new value. So in your statement of financial position, you're now putting in the new values that they gave you, the revaluation figures. So buildings was 54,000 before, but it's now 49,000. So that's what you put in. And the depreciation on building was 3,267. Somebody may be wondering where we got that figure from. When we look here, depreciation building, 3,267. If they had depreciation under the old and under the new, you pick up the total that will be here. 3,267 will be the total that you're picking up. So that's the depreciation. And the net book value now is $45,743. So we can add our total non-current assets, and let's add our tangible and our intangible, so to speak, non-current assets. And we get a total of $181,733. So I hope that persons who would have done it, you came up with some of these figures so far. Then you have your current assets. Current assets. So in our current assets, let me see. Inventory, and the inventory before was $14,900, and $800 of the inventory was deemed to be worthless. So then you get your new figure for inventory of $14,100. So the persons that would have calculated the $14,100 in the revaluation account, this is where the $14,100 should be here, because the $800 was worthless. So if the 800 was worthless, it means your inventory is no longer $14,900. It is $800 less. Then you have your accounts receivable, and accounts receivable previously was $10,100, but you had debtors that were bankrupt. So, and that was $1,100. So that has to be taken off the books of the business. So your accounts receivable now is $9,000, right? So remember, as I go through, if there's something that seems strange, you don't understand, you can say something. Then we have our prepaid expenses, which I think was a selling expense. Just put it here so that persons know where I got this here from. That was $380. And then you had, I think, cash and bank. Only thing we spoke about last week. Your cash and bank is going to be a new figure. Your cash and bank was $74,900. $74,900 was cash and bank on the trial balance. The question stated that the $6,000 that Hart had as a loan to the partnership, that the new partners were going to repay that to Hart at the end of the financial year. So that has to come out, that $6,000. Then it also stated that Hart was getting $8,000 as well. So you have to deduct that as well. So what is the new cash and bank figure? Anyone quickly? New cash and bank. Excuse me a minute.
60,900.
60,900.
Yes, ma'am.
My apologies. So we were stating, so did somebody give me the, was Shantae. Shantae, go back and give me the figure again.
Ma'am, 60,900.
Okay, 60,900.
Ma'am, I have two questions.
Go ahead.
To the accounts receivable, where did we get the 1,100 figure from?
Where we get the 1,100 from?
Yes, please.
Wait a minute. Give me a minute. Y'all can see my window that I'm sharing, or you're not seeing it?
Mama can see you at so.
Oh, because the thing is telling me something about it paused. So that is why it was telling me sharing is paused. Okay, all right. All right, thanks. Thank you. Okay, Danielle, we got it from within the question I'm going to show you now. The 1,100 here. Debtors owing $1,100 were declared bankrupt.
Oh, okay, see, ma'am.
No problem. It's good to ask those questions because when you're looking at it, so some person will sit in class and mom do something, they have no idea where it came from. So it's still good to chat back. Yes, please. It's Dante.
Yeah, you could explain the cash and bank again.
The cash and bank. Okay, sure. Cash and bank. Let's look at the question again. Here in your trial balance, cash and bank was 74,900. Okay. We are not taking out the 75,000. We're not adding in the 75,000 because that would have already been accounted for sometime during the finance. Would have been accounted for when Brown came into the partnership. That is why the 75,000 is here in the trial balance. So the cash and bank is 74,900. And then the question stated in note number 6 that Hart's existing loan made to the business on July 1st, 2011. The sum outstanding on this account is to be repaid by the new partnership on June 30th, 2013. So they have to repay. What they're referring to is this $6,000 here. That is the loan from Hart. So they're repaying this 6,000. So if they're paying Hart this 6,000, it means that 6,000 has to be deducted from this 74,900 here because it was not accounted for as yet. And then note number 7 stated Hart is to be paid $8,000 in cash at the same end of the financial year. So she's also going to be paid an additional in addition to the 6,000 loan that she's being repaid, she's going to get another $8,000 cash. So if she's getting another $8,000, it means that has to be deducted from this $74,900 as well. Is that clear?
That's one thing.
Okay, no problem. So we have that. So then let's get our total non-current assets. Sorry, current assets, $84,380. And then we add the intangible, then we add the goodwill, the non-current, and the current together. We get a total of $266,113. So now we are going to look at our liabilities. So let's liabilities. And we have our current liabilities. So we have our current liabilities, which we have accounts. I think the only one we had is accounts. Accounts. I think that is the only current liability because I don't think we had any accrued expenses. And our current liability is $7,700. Then we would have our non-current liabilities. And that is a loan from Hart again. So this is a loan from Hart. So our non-current liabilities will be a loan from Hart. And that loan is this $72,239.50. So this loan here, because remember it stated that Hart was getting the $8,000 because she was due, based on her capital account, she was due $80,239.50. That's if you round, if you round it would be a nice $80,240. This is what was due to Hart. However, the partnership paid her $8,000 out of it. And she said that whatever is left over, she is going to leave it in the new partnership as an interest-free loan. So she's leaving it $72,239.50. Now, as I said, if you round, then it should be $72,240, right? So this is our loan here. So that's $72,239.50. That's what it is. So then you add your current and non-current liabilities.
Excuse me, ma'am.
Go ahead.
You said interest free. Would there ever be a time that interest will be charged or not?
She would probably have to go back to the partnership and speak to them and change the terms of her agreement if she wants the interest. But when she left, she said it's interest free, which meaning that they're not paying any interest on the loan. So she's not receiving anything additional on that loan. So she will probably have to go back to them and decide that she's changing the agreement. And then they could decide whether they want to pay interest on the loan or if they just want to repay her the loan in full. Answer your question, Jonathan?
Yes, please. Thank you.
Okay. You're welcome. So then we subtract our total liabilities from our total assets, and we get net assets of $186,173.50. And all of this is financed by, and we get our Layne and Brown, sorry, and their capital accounts for Layne was $79,550 and Brown was $75,000. A total capital for the partners, $154,550, and then their current accounts. And this is the balance on their current account. Right now, Layne has a credit balance of $14,623.50, and Hart has a credit balance of $17,000. So these are figures that can be added to their capital, because this is profits that were not drawn. Remember, if their balance is brought down, if the carried on balance was on this side, then they will end up with debit balances, which are negative figures. So right now, Layne, $14,623.50, and Brown, $17,000. Right. So when we add up, for Layne, her total is $94,173.50. Brown is $92,000, and the balance sheet balance at the $186,173.50. And that completes the question. Any questions or any additional questions?
Hello, ma'am.
Yes, please go ahead, Julia.
Mama was gonna ask you when is our first exam?
Oh, you're based on your course schedule that is online. Your first test supposed to be Monday, October 18th. And we're supposed to start the topic of disillusions this week as well, which is all part of Unit 2. So your test supposed to be the 18th of October. If there's a change, you will be notified.
And Mom, this is online, right?
Well, most likely it will be, because as you can see, the cases are consistently rising, and we want to maintain as much safety as possible. And based on what I know, we cannot put, I think it's 33 of you all in, yes, we can put 33 of you all in one of those small classrooms. We will have to have like a bigger space to put everybody in. So if, as it said, I think on your, yes, on your schedule, it also states, so please, if you have not downloaded that course schedule, you should, because it is something you refer to. It states that the midterm test will be face-to-face on campus. If this is not possible due to protocols, an alternative arrangement will be made and communicated. So it's supposed to be a face-to-face on campus, but as we said, if protocols do not allow that, we will communicate alternative arrangements. But it is in your best interest to practice, memorize how the format in terms of the income statement, statement of appropriation, in terms of the capital account, what goes where, etc., etc. I also have to do a demonstration of the fluctuating capital account, and I will do that as well, so that you all see how a fluctuating capital account is done. So far what we would have done was a fixed capital account. We didn't do a fluctuating, but what I can do, I can go back to one of these same questions and show you how a fluctuating capital, what a fluctuating capital account would look like, right? So any other additional questions?
Oh, Mom,
Go
I was
ahead.
trying to attend Dynamite, but then when I read it, I started getting a little scared because they did the revaluation of code, and I was getting into the income statement, and then it got so stuck. I was like, I can't do this one. So I went to Gill and Taylor, and I was like, this one seemed more flexible that I could work with. So, Mom, I did up to the profit and loss, and I would have put it in the Dropbox underneath what I would have posted for Layne and Hart, so I want you to see it.
Okay, we are going to take a look at Gill and Taylor shortly, and you will see you got scared with Dynamite. You shouldn't be scared with Dynamite, but
no, man,
at
I was
least,
doing so good in the revaluation account, and then as I hit the profit and loss along with the I was like, this not gonna work with me. It ain't gonna work with me.
Chloe,
Cause I figured out
Chloe,
the
I
months and
understand.
everything good, you know. I figured out the months and everything good, and it was going good. And then when I continued trying to like divide between old and new agreement, I was like, this one ain't for me. Then I seen Gail and her, and I was like, Gail and Taylor was like, this look like something I could do proper.
Mom, I want to make a comment to Chloe. Chloe, When I started, I had that same assumption too. But as I started to do Dynamite, you just have to split the expenses half and half, right?
Right, yeah, expenses supposed to begin by the month, but I was just saying
Right.
out like the
And the
depreciation
goodwill
because
account, the
if
goodwill
the
account on the left hand side, you're using the all share and profit loss ratios, and the right hand side,
girl, I get that
you you ain't call me, Chloe. Chloe, call me.
All right, we are going to take a look at Gil and Taylor, and it should help Chloe a little bit with the dynamite. But Alicia also asked a question about the solution. Yes, I will post it online. I will put it on Trading, and you will see the solution to Layne and Hart. So I think I already have a PDF version of it, so you would get that posted after class. All right, so you can have that. So that you're welcome. So I'm gonna pause a little bit. Just a little, and then we are going to look at Gil and Taylor. Gil and Taylor is different, slightly different from Layne and Hart. So let's take a break, a slight pause for a minute, and resume.